time. Most people conduct their lives as if they intend to live forever, with no review of the past, no real planning for the future, and minimal learning from past mistakes. Freud showed that the unconscious mind does not have a notion of time. Our deep-seated wishes remain largely unchanged throughout life. When people join crowds, their behavior becomes even more primitive and impulsive than when they are alone. Crowds pay no attention to time even though they are affected by its passage. Individuals are ruled by the calendar and the clock, but crowds have no notion of time. Crowds act out their emotions as if they had all the time in the world. Most traders focus only on changes in prices and pay little attention to time. This is just another sign of being caught up in mass mentality. The awareness of time is a sign of civilization. A thinking person is aware of time, while someone who is acting impulsively is not. A market analyst who pays attention to time is aware of a dimension hidden from the market crowd. Long-term price cycles are a fact of economic life. For example, the U.S. stock market tends to run in 4-year cycles. They exist because the ruling party inflates the economy going into the presidential election once every 4 years. The party that wins the election deflates the economy when voters cannot take revenge at the polls. Flooding the economy with liquidity lifts the stock market, and draining liquidity pushes it down. This is why the 2 years before a presidential election tend to be bullish, and the first 12 to 18 months following an election tend to be bearish. Major cycles in agricultural commodities are due to fundamental production factors coupled with the mass psychology of producers. For example, when livestock prices rise, farmers breed more animals. When those animals reach the market, prices fall and producers cut back. When the supply is absorbed, scarcity pushes prices up, breeders go to work again, and the bull-bear cycle repeats. This cycle is shorter in hogs than in cattle because pigs breed faster than cows. Long-term cycles can help traders identify market tides. Instead, most traders get themselves in trouble by trying to use short-term cycles for precision timing and predicting minor turning points. Price peaks and valleys on the charts often seem to follow in an orderly manner. Traders reach for a pencil and a ruler, measure distances between neighboring peaks, and project them into the future to forecast the next top. Then they measure distances between recent bottoms and extend them into the future to forecast the next low. Cycles put bread and butter on the tables of several experts who sell services forecasting highs and lows. Few of them realize that what appears like a cycle on the charts is often a figment of the imagination. If you analyze price data using a mathematically rigorous program, you will see that approximately 80% of what appears like cycles is simply market noise. A human mind needs to find order in chaos, and an illusion of order is better than no order for most people. If you look at any river from the air, it appears to have cycles, swinging right and left. Every river meanders in its valley because water flows faster in its middle than near the shores, creating turbulences that force the river to turn. Looking for market cycles with a ruler and a pencil is like searching for water with a divining rod. Profits from an occasional success are erased by many losses due to unsound methods. If you are serious about trading with cycles, you need a mathematical method for finding them. A farmer sows in spring, harvests in late summer, and uses the fall to get ready for winter. There is a time to sow and a time to reap, a time to bet on a warm trend, and a time to get ready for a cold spell. The concept of seasons can be applied to the financial markets. A trader can use a farmer's approach. He should look to buy in spring, sell in summer, go short in the fall, and cover in winter. Just as a farmer pays attention to the vagaries of weather, a trader needs to pay attention to the vagaries of the markets. An autumn on the farm can be interrupted by an Indian summer, and a market can stage a strong rally in autumn. A sudden freeze can hit the fields in spring, and the market can drop early in a bull move. A trader needs to use his judgment and apply several indicators and techniques to avoid getting whipsawed. The concept of indicator seasons focuses a trader's attention on the passage of time in the market. It helps you plan for the season ahead instead of jumping in response to other people's actions.